Well, hello everyone and welcome to Momentum channel. My name is Mo, and in this video, we're going to be talking about 3 real estate investment trusts to invest in 2022. These are wonderful companies that are dividend payers, all of them paying a dividend yielding more than 4% and have been paying their dividend reliably for many, many years. Real estate, as you know, is a wonderful kind of sector to get involved with, and these are 3 handpicked companies that are considered to be undervalued at this time. So let's get into it. The first company for us to review is called National Retail Properties, with ticker symbol NNN or triple N, traded on New York Stock Exchange. National Retail Properties currently pays a dividend with a yield of 4.41%, and it has a dividend safety score of 70, making it a safe dividend payer. They have a market capitalization of $8.44 billion, making it a mid-cap sized company. And the stock's volatility has a beta score of 0.82. Beta is a measure of volatility of the stock. And beta of 1 suggests that the stock has similar type of volatility as the overall stock market. In this case, beta less than 1 or 0.82 suggests that the stock has less volatility than the overall stock market. You anticipate less ups and downs of the price as a result of that. National Retail Properties has its roots back to 1984 when restaurant chain Golden Corral formed a REIT to acquire its properties and lease them back. And overall, National Retail Properties has proven itself to be among the best in its industry thanks to its prudent management team, strong balance sheet, mostly e-commerce proof tenant base, meaningful diversification, and ability to grow its payout in just about any economic and interest rate environment. Let's take a look at some of the other key metrics when it comes to their dividend. The payout ratio for this REIT as 70%, which is considered low for REITs. And the forward payout ratio is also at 70%, giving it a ton of room for them to grow their dividend amounts and the distribution amounts. They do pay their dividend on a quarterly basis. Their last time that they increased their dividend was in July of 2021, and they increased it by 1.9%. which is considered very slow in that sense. In the past 5 years, they've increased their dividend by annually average of 4%, and in the last 20 years, they've increased it by annual average of 3%. Looking ahead at some of their payments for the dividend, you notice that they do pay their quarterly dividend in the months of February, May, August, and November, and they have an annual payout of $2.12. The company, National Retail Properties, has paid its dividend for 30 years uninterrupted. And in all of those years, year after year, they've increased their dividend payments. In terms of the valuation, for the National Retail Properties, their current dividend yield of 4.41% is about in line with their 5-year average of 4.5%, suggesting that stock may be reasonably well valued today. Moreover, if you look at their price to adjusted funds from operations ratio, you notice that ratio is at 15.8, which is about in line with their 5-year average of 16.1. And if you compare that to that of the real estate market, the price to adjusted fund for operations for real estate is at 20. It seems that this, overall, the market has been valuing the stock similarly to how it has done it in the past. It is a slightly different. If you look at it in the past, many times when we analyze this company, we look at the price to earnings or PE ratio, whereas here we are talking about P/AFFO. The reasoning being is that the price to adjusted funds from operations ratio is actually mainly used for real estate investment trust, and it gives us the ability to assess how able they are to pay for their dividends to shareholders in the long term. We are, as a result, going to be taking a look at a number of additional financial metrics, but these are specific to real estate investment trust. For example, we are going to take a look at their historical adjusted funds from operations payout ratio, their net debt to EBITDA, as well as their net debt to capital. And again, as we indicated, these are specific metrics that usually we are going to take a look at when it comes to a real estate investment trust. It's worth mentioning that funds from operations, or FFO, refers to the figure used by real estate investment trusts to define the cash flow from their operation. And real estate companies use FFO as a measurement of operating performance. It is worth also mentioning that FFO subtracts any gains on sales of property, because these type of sales, when a real estate investment trust is getting rid of or selling some of their properties, does not happen on a recurring basis. It could be on one-off situations. As a result, it is something that important for us to take into account, and hence looking at the adjusted funds from operations. REITs must pay out about 90% of all taxable income in the form of dividends, which are cash payments to investors, and gains on sales of property do not add to their taxable income and should therefore not be included in the measurement of value and performance. If you look at the adjusted funds from operation payout ratio for REITs, we'd like to see this number below 90%. And it has been the case since 2011. And with the exception in 2011, they were right at 90%. But in the last 12 months, it is shown at 70%, and next 12 months expected to be at 70% too. Net debt to EBITDA indicates how many years of EBITDA, or a proxy for cash flow, a company would need to pay off all its debt, net of cash on hand. And in this case, we'd like to see this less than 5.5. In other words, it takes less than 5.5 years for the company to pay off all of its debt. In this case, for the last 12 months, this ratio was at 5.11, and the next 12 months is even better at 4.75%. So it gets a pass mark for us here. Lastly, the net debt to capital, which is the proportion of a company's finances and financing that is from their debt, net of the cash, rather than equity. In this case, companies with a higher dependency on debt to fund their operations, day-to-day operations, can be more likely to run into trouble, and would like to see this number less than half. In other words, less than half of the company's financing comes from debt. It has been the case for the past 10 years, and in the last 12 months, it's shown to be at 0.43 this ratio. Moving on, let's take a look at the stock return the past 1 year and the past 5 years. The graph on the left shows you the stock return in the past 1 year. The stock has had an impressive 22.16% 1 year return. The 5 year return, though, has not been as impressive. It has been at 4.96% total cumulative return for the past 5 years. But if you look at it, during the March declines of March of 2020, that could have been a wonderful opportunity for many investors to get in. Sometimes when the stock has huge pullbacks, those present great opportunities for patient investors to get in and dollar cost average and add to their existing shares. Let's move on and take a look at analyst estimates. Analysts on tip ranks, with 5 of them having coverage for this stock, 3 of them have a buy rating and 2 of them have a hold rating, giving the stock a moderate buy with the price target of average $52.25 US dollars. And if that holds true, that shows an upside of 8.70% for 1 year. Analysts on Yahoo Finance have a price target of $52.17 1 year. And lastly, if you look at analysts on Simply Wall Street, according to them, the fair valuation for the stock is at $92.90, giving the stock an undervalued rating of 48.3%, or it's undervalued by about 48%. Before we move on and continue to take a look at the second real estate investment trust, which is undervalued and great option for investors in this year, I will have a big favor to ask you. I've put a ton of time and effort to put this video together, and I really appreciate if you can give this video a thumbs up and subscribe to our channel. Here on Momentum Finance and Investing channel, we post every week several videos about investing, whether it's investing in the stock market, real estate, cryptocurrencies, as well as ways to reach financial freedom. The second company for us to take a look at, another real estate investment trust, is Store Capital, with ticker symbol STOR, traded on New York Stock Exchange. The company was founded in 2011 by a management team that previously built successful triple net lease REITs, and the company has grown its property portfolio with a very, very fast pace. They do pay a dividend currently yielding 4.48% and has a dividend safety score of 70, making it a safe dividend payer. It has $9.43 billion in market capitalization, making it another mid-cap size real estate investment trust. And their beta or volatility score is at 1.03, suggesting that stock is slightly more volatile than the overall stock market, but as a whole average volatility for this type of companies. With their conservative payout ratio policy, Store Capital has raised its dividend each year since going public in 2014 and has attracted even investment from Berkshire Hathaway, Warren Buffett. Overall, Store Capital disciplined management team, healthy balance sheet, focus on internet-resistant tenants, and predictable rental income make it a wonderful and appealing high-yield investment for dividend growth portfolios. Let us take a look at some key metrics. Their payout ratio at 76% and the forward payout ratio at 72%, both of which being low for REITs, giving them a ton of room for increasing their dividend. In fact, their last dividend increase was in September of 2021 with 6.9% increase, considered an average dividend growth. In the last 5 years, they have increased their dividend by average of 6% annually. They have increased their dividend uninterrupted for the past 6 years. And in fact, they have paid dividends since 2014, ever since they went public. Their payment for payout ratio for this stock is at $1.54, and they're paid a dividend on a quarterly basis in the months of January, April, July, and October. Let us take a look at valuation metrics. Store Capital's current dividend yield of 4.48% is about in line with their 5-year average of 4.55, suggesting the stock may be reasonably valued today. Their forward price to adjusted funds from operation of 16.2 is also about in line with their 5-year average of 15.5, and less than that of the real estate sector. Their price target, actually the price for the stock at $34.40 at the time of making this video, is hovering a little bit closer to the 52-week high price, which was at $36.76, but their lowest price in the past 1 year was at $30.32. Let's take a look at a number of additional financial metrics. You'd see for all the past years since going public in 2014, the stock has maintained the ratio of adjusted funds from operation payout at below 90% and 72% for the next 12 months estimated. Their net debt to EBITDA, ideally we would like to see this less than 5.5. You'd see that it is currently for the last 12 months has been at 6.15, so a little bit less, more than what we were anticipating. That's not as desirable, but in the next 12 months, they're anticipating to bring it below 5.5 and estimated to be at 5.28. The net debt to capital, ideally we'd like to see a number below half, and this has been the case since 2014. And for the last 12 months, it was at 0.44. Let's take a look at stock returns. The stock in the past 1 year had a modest return of 7.17%, but the past 5 years, the stock has had an incredible 35.22% return, which is decent for real estate investment trusts. Moving on, looking at analyst estimates, 7 analysts on TipRanks cover the stock. 3 of them have a buy rating, 4 of them have a hold rating, making it a moderate buy for the stock. The price target 1 year is at $38.18, giving it an upside of close to 11%. Analysts on Yahoo Finance give the stock a 1-year price target of $38.19. And lastly, analysts on Simply Wall Street value the stock with a fair valuation of $87.09, making it undervalued by 60.5%. Next, we're going to take a look at the third and final real estate investment trust that is undervalued to consider for investing or adding to your watch list. And this is Realty Income with ticker symbol O. It is traded on New York Stock Exchange. Realty Income does pay a dividend with a yield of 4.13%. It has a market capitalization of $40.7 billion, making them a large cap company. It has a dividend safety score of 70, again, making it a safe dividend payer. And from a volatility perspective, it is less volatile than many other real estate investment trusts with a score of 0.65, categorizing as a low volatility. Realty Income started back in 1969 with a single investment in Taco Bell. And today, the retail REIT owns thousands of properties across America that are leased to hundreds of tenants operating in dozens of industries. Retail properties account for most of Realty Income's rental revenue, though some of it comes from industrial warehouses, office buildings, and farmlands. Overall, there are predictable cash flow, strong balance sheet, disciplined approach to acquiring properties, diversification, and access to low-cost capital make the firm a solid dividend payer among the safest of the real estate investment trust. Realty Income has a payout ratio of 81%, which is edging a little bit higher for REITs. Their forward payout ratio is at 76%, which is considered low for REITs. They have increased their dividend 3% last time in 2019 to 20, which made it a slow dividend grower. Last 5 years, they've increased it by average of 4% per year. Again, another slow growth in that sense. And lastly, over the span of the past 20 years, they increased their dividend on average 5% per year, considered an average dividend growth. What's worthwhile mentioning is that during the recession of 2007-2009, they did actually continue to increase their dividend, which is remarkable. In fact, they've been paying their dividend uninterrupted for the past 26 years, of which they have increased their dividend each and every year. It is interesting that Realty Income does pay its dividend on a monthly basis, and their annual payout ratio is at $2.96. From a valuation perspective, Realty Income's current dividend yield of 4.13% is about in line with their 5-year average of 4.37%. and their forward price to adjusted funds from operation ratio of 18.5 is about in line with their 5-year average of 18.5, though it's less than that of real estate sector. Their price is hovering a little bit closer to their 52-week high price. The 52-week high price for the stock was at $74.10, and the lowest was at $57.78. Looking at a number of additional metrics, for adjusted funds from operation payout ratio, we would like to see this number below 90%, and that has been the case for the past 10 years, with the next 12 months estimated to be at 76%. Their net debt to EBITDA, we'd like to see this less than 5.5, and the last 12 months, they hovered closer to that range with 5.45% ratio, and the next 12 months, this ratio is estimated to be at only 3.24, which is very good. Their net debt to capital, we'd like to see a proportion less than half. In other words, we would like to see the company less than half of its financing is from debt. In this case, the last 12 months, it's at 0.40, which is actually acceptable ratio for us. Stock return is quite interesting. The past 1 year, they have had a 23.49%. And if you look at it, the past 5 years, very similar return of 23.54%. In other words, if you bought the stock 1 year ago or 5 years ago, you wouldn't have seen much more of a difference in terms of the stock performance returns. Though keep in mind, this does not take into account your dividend income that you would have earned from holding this Realty Income, which actually does pay its dividend on a monthly basis. Next, we're going to take a look at analyst estimates. There are 8 analysts on TipRanks. 4 of them have a buy rating, 4 of them have a hold rating, giving the stock a moderate buy, but a 1-year price target of $77.50, giving it an upside of 8.26%. Analysts on Yahoo Finance have a 1-year price target of $78.71. And lastly, analysts on Simply Wall Street calculate the fair value for a stock as $171.13, marking the stock undervalued by 58.2%. Well, there you have it, folks. A quick look at 3 undervalued dividend stocks as a real estate investment trust that are perfect investment options for investors in the year of 2022. I hope you found this video beneficial and gained something of value from it, gave you some understanding of how we go about analyzing these companies, in this case, real estate investment trusts. Are you invested in any REITs? Would love to hear from you. Let us know in the comment section down below. If you found this video beneficial, please don't forget to give this video a thumbs up. It really means a lot to us and helps the channel to grow. And of course, don't forget to subscribe to our channel. Here on Momentum Finance, we post every week several videos about investing, whether it's investing in the stock market, cryptocurrencies, real estate, as well as ways to reach financial freedom. Thank you, and I hope to see you next time.